Hey, the recession is not canceled. I mean, this chart right here says there's a 100% chance a massive recession is coming. But Bernard Bamoul of the Economic Outlook Group sent out a research memo on June 29th declaring, ladies and gentlemen, the recession has been canceled. But what about this chart? It says something very different with 100% certainty, proving that Bernard, MarketWatch, Bloomberg, and even the constantly negative news network are 100% wrong. So we've got facts and we've got opinions. I'm gonna show you both sides so you know exactly what to do next. You ready? Let's go. I got an email from my friend Mike Dillard this week, and it sent me down a rabbit hole, a deep one. And here's what I learned, and what you deserve to know as a consumer and as a real estate investor, especially if you're concerned about how the housing market will react to a recession. Now, I don't know if you've been watching, but the stock market, it's been on its way up. It's climbing higher and higher and higher, closer to its highest point ever. Now, nobody predicted a full recovery by this time in the stock market, let alone toying with an all-time high. Well, imagine that we've got this super cool crystal ball. It can't predict the lottery numbers, bummer, I know, but it's never been wrong about predicting the stock market's future. What would you give for a crystal ball like this to be able to predict the stock market? No need to answer, because I'm gonna give it to you for free, but only if you hit the like button. You see, that crystal ball actually isn't imaginary. It exists. It's this chart right here showing something what's called yield inversion. Oh God, what's a yield inversion? If only someone could just explain that to us like we were 5. Hey there, kiddos. Captain Casharoo here. Yield inversion, huh? All right, well, it's like this. Let's say you got a buddy and he asks you to lend him $10 for a year. He promises he's gonna give you back $11. Well, that extra $1, that's your reward for waiting. It's called interest or yield. Now, you've got another friend and he wants to borrow the same $10, but for 2 years. So if he also gives you back $11, that's not right, is it? I mean, you'd expect a bigger reward, say $12 or more, for waiting a year longer. This idea is the foundation of treasury bonds. You see, when your government needs to borrow some money to pay for important things like building schools, fixing roads, or helping people, they create something called a treasury bond. It's like an IOU. And people, like your parents, can buy these IOUs trusting that they'll get a little extra thank you for letting the government use their money. And that little extra is called interest or yield. Just like when your buddy gave you $11 for borrowing 10, understand? Normally, a 10-year US Treasury bond, like lending your buddy money for 2 years, should give you more money back than a 2-year bond, like lending your buddy money for just 1 year. But when the opposite happens, when the 2-year bond gives you a bigger return than the 10-year bond, that's when we have this thing called a yield inversion. This unusual switcheroo is an early warning sign, like your mom when telling you to tidy your room up because grandma is visiting for the summer. It's trying to tell us a recession is on its way too for a summer visit. It's actually not trying to tell us. It is telling us with 100% certainty that a recession is coming to visit. If the chart is wrong, it will be the first time it ever has been. As you can see here, every time the blue line drops below the horizontal black line, we have a yield inversion. And as you can see, they party together in a wild roller coaster ride. And we call this ride the economy. When the blue line starts climbing back up toward the black line, we're in for a major economic slump, like a recession, or God forbid, a depression. These not so fun times are marked by the gray vertical lines that you see. This exact sequence happened 6 times out of 6 since 1980. And as you can see here, the blue line is below the black line right now, but it won't stay down there forever. At some point, likely within the next few months, it's gonna start shimmying back up to cross the black line again. And if this was a game of chance, we'd be looking at a 100% chance of a big, bad economic crash. So, when? The experts, they're having a tough time answering that question. Ambrose Evans Pritchard, world economy editor of the Daily Telegraph, who has covered world politics and economics for 30 years, says the global recession has been postponed, not canceled. But then he's currently pondering the question, have we averted a hard landing or simply delayed the inevitable? Dick and Hyatt at Investopedia agrees that the recession keeps getting postponed, but he follows it up with, it may never come. Look at it like this. Imagine you're back in grade school, waiting for the school bell to ring, but it didn't ring when it was supposed to. So you think, hey, I'm just gonna keep playing dodgeball until it does. That's kind of what's happening right now with the economy. People have been waiting and waiting for the recession bell to ring, and we're still waiting. There's a bunch of smart people who study this stuff, and they've got all these fancy tools like charts and graphs to predict when a recession might happen. But lately, these tools are acting like your little brother who swore he saw a monster in the closet, but when you go to check, no monster in the closet. Are these economic tools crying wolf like your little brother? Although all signs are pointing to a recession, the experts are starting to think this time is different. Or they're patting themselves on the back right now saying, we've figured out how to stop recessions. But this is why it might be different. We've got this shining ray of hope called the job market. Currently, we've got the lowest unemployment rate since 1969. That was 54 years ago. Low unemployment and recessions, though, they don't coincide. As you can see here, just prior to each recession, dating back to 1948 when we started tracking this number, there's a noticeable uptick in unemployment just prior to entering a recession. Right now, you'd have to go back almost 80 years to find the unemployment rate lower than it is right now. And it's still trending downward right now. So despite everything, workers are in high demand. This is typically what we see after a recession, not before a recession. So maybe this time is different. Know this though, like that game of dodgeball, the tables can turn in an instant. So what do? Well, first, stocks should continue to rally for a bit, but watch your greed. Yet there's no need to panic sell either. The second, stashing some cash, that's time-honored advice during times of uncertainty like this, so you might want to do that. Third, take on a side hustle or a second job to earn more money to stash away. Fourth, play conservatively, but play, because we could see a market crash and we don't want to get caught with our pants down. Yet we could dodge the market crash, dodge the recession altogether, and find out that we missed a real opportunity. Real estate, it is your conservative play. And there are two big reasons for this. First reason is all about the housing market and recessions. Historically, there's no correlation. Most people think that there is because the most recent major recession and housing crash of 2008, they happened at the same time. Previously though, as you can see here, those gray vertical lines that mark recessions, housing markets were flat, or they actually rose during the dot-com recession of 2001 and the COVID recession of 2022. And if we go back, they also rose in the recession of 1990, 1981, 1980, and 1973. So that's number one. Recessions and the housing market crashes are not related. And if they were, a strong case, according to this chart, could be made for the housing market to more likely appreciate during a recession than crash. Reason two, and this is where it is different. In 2008's housing market crash, there was a fundamental imbalance of supply and demand. We were overbuilt and didn't have enough people of home buying age to buy all the houses that had been built. When you have too much supply like this, that's when you get a bubble that eventually pops. Thus, you had 2008. Now, fast forward to today, and that supply and demand seesaw has tilted in the opposite direction. With a decade's worth of building deficit and the peak age of our population passing through the average first-time homebuyer age, we have a fundamental imbalance of supply and demand again. But this time, we are underbuilt. And this is not a precondition for a bubble popping. I mean, if anything, we've got a people bubble, not a housing one. This article on Builder Online, just released, it makes three compelling points for a strong housing market. First point the article makes, the median existing home price is up 23.4% from last year to a whopping $363,300. And that's no fluke either. It's a 112-month streak of year-over-year gains. The second point it makes, the average days on market last month was just 17 days, and 89% of all the homes sold in less than a month. And the third point it makes, the unsold housing inventory is sitting at a measly 2.6 month supply, almost half of what it was pre-COVID. So less supply with more demand, that equals higher prices. It's economics 101. So what's the takeaway here? Well, with properties flying off the shelves, inventory doing the limbo, and prices on a marathon run, it's not reckless to conclude that the real estate market isn't just stable, it's thriving. For all the doomsday prophets predicting a crash with their clickbait headlines, you might want to hold on to your hats because this rocket, it ain't coming down anytime soon. Sure, all the negative Nancys will eventually be right, but not anytime soon. Now, let's say you disagree with me because you have your own information that has you believing a crash is just right around the corner. Well, if it happens, you want to align your investments with where people will be spending their money during an economic slowdown. And I'm talking about their basic needs. That's where they're going to spend their money, on food and energy and shelter. Yeah, shelter, housing. If you're going to park your money anywhere long term, the demographics and economics are in your favor for investing in real estate. Certainly more in your favor than anything else available to the average person without insider information, of course. That's another story for another time. But in the meantime, keep it simple. We have more people than housing. People need housing. So invest in housing, long term, for income and equity building. For the next 10 to 15 years, it's as safe as a bet as investing in water and air. Listen, all we have are educated guesses and maybe a few fingers crossed. Whether preparing for the storm to hit or finding ourselves in the eye of the storm, it's not the time to run and hide, but rather to gear up and play smart. The game's only over when you stop playing. So what are your thoughts? What information do you have that suggests something different? Share with me below, I wanna know. And who else do you know that should see this? When their name comes to mind, please share it with them. Oh, and I pulled this video out special for you to watch next. Otherwise, I'll see you next time. Thanks for watching. Take care.